Yes, I'm trying to explain. A business is taxed on profits. Accounting one, you learn how to construct the income statement. And what we know is you have incomes, less expenses. The difference is what we call profit. So when you have made your profits, that's what you'll be taxed on. But it's not exactly those profits that you made from accounting one. Now, that's where we have what we have to teach now for this unit, because those profits, we have to make some adjustment to them. Remember, the concept of taxing business income falls under Income Tax Act. We'll have to go and consult what is written in the Income Tax Act, Chapter 470, Laws of Kenya, and see how we'll be able to determine the taxable income of a business. Now, I remember showing you this. We are missing something here. This lady is trying to explain that she's running some sort of community-based activity, but it is actually trading. And she's saying out of the collection of garbage or something like it from the community, she's able to get some money. And then we are actually telling her, now see the response that she's getting. She's being told that she has to pay taxes from that activity that she's engaged in. She has to pay taxes. You see. She has to pay taxes. So when you run a business activity, you have to pay taxes. We have to define the concept of profit, and profit is the excess or periodic revenues over what? Expenses. We are together, Greg?
Yes.
Now, profit equals to sales minus expenses. So take this simple example. This business has made sales of 100,000. But to make the sales of 100,000, they pay rent, they pay salaries, they pay to purchase the materials that they're selling, they incur a total cost of 85,000. So you can see that they have a profit. They not be taxed on 100 because they have to be taxed on the profit. They'll be taxed on 15, the profit. And you can see how we have calculated that profit. Now, we have this definition of an expense. An expense is the cost of operation that a business incurs to generate revenue. I need now to introduce you to this. Okay? At this point, I need to introduce you to this. This income statement we are talking about has two items. Any income statement has two items. It has incomes and then it has expenses. So it has incomes and it has expenses. We know that. And we know that profit is the difference between the two. Now, for tax purposes, these items will be divided into two, each of them. For expenses, we are going to have two types of expenses. The same expenses that you know. Now, when it comes to tax, we divide them into two. And we'll have expenses that we call them allowable. And we have expenses that we call disallowable. Okay? And for incomes, you have two types of incomes. You have incomes that we say they are taxable, right in full, and incomes that we say they are not taxable. Understand that right from the word go. So you need to understand what is an income. And that one you need to understand from your introduction to accounting 1. And then what is an expense. And now in this unit, we come to introduce the distinction between two types of incomes, that there are some incomes that are taxable and there are some other incomes that are not taxable. Expenses, you need to understand what is an expense, and that is from your accounting 1. Now, we need to understand that we have two types of expenses. There are expenses, A stands for allowable and D stands for disallowable. If you understand that distinction, then this topic will be smooth. It will be so easy. So we start with the expenses and then later we'll come to incomes. Have in mind that now the expenses that we had in the income statement, as we learned in Introduction to Accounting, we are going to split them into 2. Do you remember the expenses? Do you remember the flow of the income statement? Expenses would have things like rent, electricity, insurance, depreciation, provision for doubtful debts, bad debts written off, all those things. Try to remember how you'd have the income statement. Now we split this into 2. Now, is it refusing to scroll? Okay. Expenses, as you can see there, they are classified into allowable or disallowable. What do we mean by allowable and disallowable? Allowable means the tax law allows you to deduct that amount as an expense. When we say it is disallowable, what it means is the tax law does not allow you to deduct that amount as an expense. What I'm trying to say, in accounting, you deduct all expenses. But now when it comes to tax, you'll be taught that some are allowable and others are not allowable. Okay? So the law will tell you the ones that are allowable and the ones that are not allowable. So what is the basis of saying an expense is allowable and another one is not allowable? Let's see whether this helps. Allowable expenses. An expense is allowable if it is incurred wholly and exclusively for purposes of running the business. An expense is allowable if it is incurred. This is the most important criteria. There are some nitty-gritties down there, but the most important thing is you get this statement. An expense will be allowable. You'll be allowed to deduct that expense if it has been incurred wholly and exclusively for running the business. Like you're running that business as a supermarket where there must be employees. You must have employees to run a supermarket. You must pay the rent if you don't own the building. You must pay for transport of these goods to be brought to your store. Now, there's no way you'll be able to run that supermarket without incurring such expenses. So you should be able to judge yourself and see in the nature of a supermarket business, you must incur expense like rent, like the purchase of the goods and all that. And you can see that expense is incurred 100%, so to speak, for purpose of that business. The owner of the business has no reason to incur that expense except for the purpose of making the profit that is making. Otherwise, we are saying the profit cannot be made if that expense is not incurred. Therefore, we come and judge that that expense is incurred wholly and exclusively for purposes of running the business. On the contrary, we have expenses that are known as disallowable expense. And the general criteria, the first thing that we check the first diagnosis to determine whether expense will be disallowed if it has not incurred fully and exclusively. Whenever you have to deal with an expense and you'll be getting a list of many expenses, first test, has it been incurred fully and exclusively? To the converse, has it not been incurred fully and exclusively for running the business? All right. Let's for example, this is common with sole proprietorships. That this guy owns the shop, not owns the shop, he's renting the shop building. Those things look like this. If you go to guys who operate, this is the place where his dad is doing his business from. And here is the shop. Apple, kuna shop. And here you have his bed and he cooks from here. So this is the private residence. This part here is the residence of this guy. So he pays rent for the shop. He also pays rent for this other place where he's staying. The question is, where he stays, is it part of the business operations? Do you think that is an expense? Can you speak? Do you think that is part of business operations?
No.
No. So, with private expenses, we normally say they are not allowable. Private expenses are not allowable because really we cannot say you must incur that expense to run that business. Okay? But the rent that is paying for the shop space, that one will be allowable, exclusively allowable because it is for the business. So one criteria that you see from this distinction is business expenses will be allowable, non-business expenses or what we call private expenses will not be allowable. Now, tuendelee na mbele. The treatment of allowable expenses is that we deduct them against sales. We less them. These ones that are not allowable are not deducted. Are not deducted. The ones that are not allowable. All right. Now, I'll come back to this statement that they are not deducted. If an expense is not allowable, you should not deduct it. We'll come back to that statement and expound on it. Examples of allowable expenses. Okay. And then you'll have examples. I think I have nice notes. This is written so precisely. Examples of allowable expenses. One is revenue expenditure, and you can see to the contrast, we have capital expenditure. Can we differentiate between capital expenditure and revenue expenditure? Because revenue expenditure is allowable, capital expenditure is not allowable. Now, can we differentiate between revenue expenditure and capital expenditure? Someone help us. From what you learned, Introduction to Accounting 1, or Financial Accounting as you call the unit, BAS 100. What is revenue expenditure and what is capital expenditure?
I can try. For revenue expenditure, I think these are expenditures that are being used to generate the revenue. Like, for example, say the insurance costs, the cost of maybe salaries and so forth.
Capital. Someone else can help.
I would maybe based on his explanation, I'll assume capital expenditure basically goes into assets or basically the assets of building the company. I don't know.
Yes, capital expenditure is incurred on assets. This is the distinction between capital expenditure and revenue expenditure. Revenue expenditure gives you benefit. You benefit from the expense for a period less than 1 year. Okay? Whereas capital expenditure will give you benefit for a period in excess of 1 year. So, if you pay salary for the month of July, that employee will not work in September because of the July salary. That expense gives you benefit for a very short period. When you pay rent in July, you not sit there in October because you pay rent in July. October rent will be asking. So that expense will benefit you for a short period. Short means any period less than 1 year. Capital expenditure, on the other hand, will give you benefit for a period in excess of 1 year. Like if you buy a lorry today, you use the lorry today, you use it next year, you use it in 2027, and the benefit from that expenditure is long term. After you have incurred the expenditure, you benefit from it for a long period. And long means more than 1 year. So basically, revenue expenditure is that expenditure that is incurred on routine day-to-day activities of an organization. It is allowable. Revenue expenditure is allowable, subject to some provisions that may come along. Capital expenditure is not allowable. When you acquire assets, that cost of acquiring the asset is not allowable. And costs that come alongside the process of acquiring assets, which we call incidental cost. Okay, so continuation of this. Allowable expenses. I want you to internalize this. Business operating costs are allowable. Losses written off. When a customer refuses to pay you, you cannot recover, and it reaches the end, you write it off, is allowable. Maintenance and repairs of assets is allowable. Legal costs of protecting assets are allowable. Payment of operating licenses are allowable. Salaries to employees and all expenses in the name of staff welfare. If you incur costs for the benefit of your staff, it is allowable. Interest on loans would be allowable to the extent that those loans, hope I'm not breaking, my internet is powered by the phone. When someone calls, it gives trouble. There is some special interest that is not allowable. One is interest that is connected with like payment of taxes. And we are going to see on this other side. Disallowable expenses.
You are breaking.
Yeah, someone is trying to call my phone. Let me look at it. Sorry. Hope you had that minute to reflect on what you are trying to say here. So look at expenses that are not allowable. I say private expenses for the proprietor, provision for future losses. Okay? Like provision for the food debts. If the debt has become bad and you have written it off, it's okay. But telling us they might occur and we are creating a provision for it, that provision is not allowable. Depreciation on assets is not allowable. Depreciation is not allowable because depreciation is an accounting estimate. It's not a real expense. It's not the way you pay salaries and you can show, I've paid this money somewhere. Depreciation is, we call it a non-cash expense, is an estimate. Depreciation is an estimate. You just say this asset is depreciating at 20%. You know, someone else will come over and tell you it is depreciating at 30%. So it's basically an estimate, is not allowable. Legal cost on acquiring assets. Why we say legal cost on acquiring assets are not allowable? Because when you incur legal cost, like you are acquiring a building and you pay legal cost on that, that cost should be added on the cost of the building itself. It becomes capital expenditure. Next is payment of taxes. When you pay taxes, it's not an expense. Payment of taxes is not an expense. You don't claim it as an expense. And the expenses in connection with payment of taxes, like interest on loans acquired to pay taxes, cost of tax appeals, you are normally told each party to bear their own cost. Drawings by the owners. When you make drawings as the owner of the business, when you take money out of the business or any private expense, as we had said earlier, those ones will not be allowed. Dividends paid to the owners in case of a company will not be allowed. And we should add to this list any expense in connection with illegality. When you incur illegalities, you breach contracts and you pay penalties and so forth, those expenses will not be allowed. You see that? Those expenses will not be allowed. So start forming the idea in your mind that there are some expenses that are allowable and others that are not allowable. Now, let's go here. You are required to be ticking against these expenses, whether it is allowable or not. Business fees inclusive of subscriptions, permit, licenses. Is it allowable or not? Can we do chorus answers? Business fees, subscriptions, permit, and licenses. Is it allowable?
Not liable.
Why not?
Not law.
Yeah?
I believe these are allowable expenses.
They're allowable, man. If you are required to operate a hotel and you not operate that hotel without the county council permit, how do you operate? It's expenditure that you have to incur for you to run that business. It is allowable. Except that we disallow things like licenses if they are once off. It becomes capital. But if it is a license that is renewable, you have to allow it. Payment of interest on a loan. When you have a loan and you pay its interest, allowable, not allowable?
It's allowable.
It is allowable. What about the payment of the loan? When you pay loan, payment of the principal component of the loan, let's put it that way. Payment of the principal component of the loan. And you are guessing it is not a liable. If I give you 10,000 and after 2 weeks you return to me 10,000, how did you incur an expense in that transaction? How did it cost you? The cost is if I give you 10,000 and then next week I ask you to bring 11. Now this excess one, which is interest, is what is an expense to you. So you'll also be required to apply a lot of common sense, because here you'll be judging. To say this is a liable, you have to apply that common sense, which tells you if you had a loan and you repaid it, that getting loan and repaying, you don't incur an expense. The expense that you incur is actually the interest. What you allow is the interest, not the loan itself. Payment of taxes, that one is straight away and provided in the act, that is not a liable. Depreciation. Depreciation on an asset, a liable, not a liable?
Not allowed.
Not a liable, we have just discussed. Insurance.
Insurance is allowable.
Okay. Can you read through these items, write them down, indicating whether they are liable or not? Read through, noting whether they are liable or not. Or these things that you have annotated, zinatusumbua sasa. It's time we erase them. So let's read through this list. So let me give you answers. Cost of advertising marketing is liable because, let's start with electricity, because it's a cost that we incur wholly and exclusively. The first is check whether it is incurred wholly and exclusively. Okay. Next is cost of advertising marketing is incurred wholly and exclusively. You are not advertising for your benefit, you are advertising for the business. Payroll expenses that are inclusive of employee taxes, benefits, and wages, those payroll expenses are liable. Staff welfare costs are liable. Cost of acquiring office equipment, is allowable. Sorry, is not allowable. Cost of acquiring office equipment is not allowable. It's not allowable. Reason, equipment is capital in nature. Equipment are assets, is not allowable. Sorry. But the cost of maintaining the equipment is allowable. Cost of goods sold, those items that you are selling, how would you be in business if you did not buy them? The cost of those items is allowable. Marketing, advertising, promotion is allowable. What about linen for proprietor suits? This guy is running hotel. He also takes his suits there for laundry. Is it allowable? For the proprietor? No.
No.
But for the linen, the ones that you find on the table of the kitchen of the hotel, they have to go for laundry. Is that allowable?
Yes.
Yes, it is. Salaries, benefits, allowable. Tell me about these two. Are they allowable?
No.
Reason? Why would you say no? What reason do we give?
They're not really essential in running the business.
There's express provision for these ones. And we talked about illegalities. If you have to pay fine, you have to pay penalty, you incur legal costs for breaching a contract, those ones are not allowable because of their illegal connection. But lobbying expenses, okay? Lobbying expenses, like you're in a particular line of business, you sell electronics, you sell computers in a Nairobi town, and now you want to lobby the government to buy computers. You want to bring together those guys that are selling computer like you. You want to put them together so that you can go to the government so that they buy them from you. Are you not doing so to promote your business?
Yes, it's allowable.
It's allowable. But contribution to political party is not allowable. A reason why we say it is not allowable is because how does that have to do with running of your business? Okay. You have another set of expenses over here. Selling general administrative expenses. Let me show you the ones that are not allowable. First, read through them, then I'll show you. Okay. Now, these are not liable. Proprietor family is not liable. Oh, I had forgotten this one, which all of us know. By the first thing that you should always know is that depreciation is not liable. Ukianza tu kufanya unajua depreciation is not liable. Okay? Now, you can ask a question. I was saying proprietor family meals where you eat is not part of the business. Is not the operation of the business. Home rent, renting where you stay is not allowable because that is private. But these home office expenses, we say disallowable. As long as you can show us that is home office, that space is for office. Some people operate like that they turn the dining area of their house to be an office. That would be an allowable expense, but it would only be allowable if you are paying it separately for that purpose. I have a friend who has rented 2 houses, opposite doors in an estate. One place is where he lives, and then the other side is where he has the office. And now, because he's the head of that organization, his other colleagues come to that space. Okay, they come to that space. There's this office fully furnished, everything. That's where they operate from. Now, under that kind of arrangement, the space that they are paying for office, that is purely business, is allowable. Okay, so you can ask a question if you have. Now we have seen how we be able to differentiate whether an expense is allowable or not. Now, how do we adjust income for tax purposes? We normally start with the net profit. Remember, construction of the income statement, we were used to starting with sales, then we arrive at the profit, sales less expenses. But now, we'll have a different kind of scenario. We have already determined the profit. And in determining those profits, which are here, you must understand, to arrive at these profits you are seeing here, someone must have constructed the income statement which started up there, and up there was sales, then expenses, and you add all manner of expenses, I mean allowable and disallowable expenses. So to arrive at this net profit figure, you have deducted allowable expenses, and you have also deducted disallowable expenses. Now we come to make an argument here. Those expenses that you have deducted, remember we have just shown expenses that are allowable and the ones that are not allowable. Those ones that you have deducted and they are allowable, it means that they should have been deducted. Okay? You deducted them and they should have been deducted. In the income statement that is prepared for accounting, you deducted those expenses and they should be deducted. So we don't make any adjustment for those expenses, okay? Because they were deducted and they should have been deducted. But there are other expenses that were deducted to arrive at this net profit. But we now have knowledge that those expenses should not be deducted. Concerning those expenses that you have deducted but should not have been deducted, you have to reverse. You have to do the opposite. This is what you need to learn. This is the lesson for today. For those non-deductible expenses that have already been deducted, you do the opposite of deducting, which is to add back. We use the language of adding back. You add the disallowable expenses, the expenses that are not allowed. And then you might also have, as a result of an error, that there are some incomes that are taxable and they were not captured in the income statement the income statement that gave you this figure. Now, those incomes, if any, that was omitted, then it's time you add it so that you tax it. And then you are going to have your figure over there. Then you deduct non-business income, or we call it non-taxable income. There are some incomes that are not supposed to be taxed. And which incomes are these? One is income that is exempted from tax. If in there you have some incomes that are exempted from tax, then you need to deduct them so that you don't tax them. And if there are some incomes that are subject to final withholding tax, then you need to remove them from your computation, and you remove them by deducting them. Then you are going to less allowable expenses omitted. If there is a tax allowable expense that was not captured in the income statement, then you need to deduct it. I give you a fine example, which is known as capital allowances. We have seen that depreciation is not allowable. Depreciation is among the disallowable expenses that will come and add back here. Why you disallow depreciation is because it's an estimate whereby you say a computer like this, you want to give it 50% depreciation. They say you cannot just guess that you are going to give it 50%. What they do is now the tax law will give you a standard rate for depreciation on computers, on furniture, and all those items. Now that standard depreciation is allowable. What they disallow is yours, which is your estimate, and now replace it with theirs. They disallow your own depreciation and replace it with the equivalent of depreciation, which we call capital allowances. So as you disallow depreciation and add it back, you less the equivalent of depreciation, and the equivalent of depreciation for tax purposes, we call it capital allowances. Now, when you have less this amount, you have deducted, this one is to be deducted like this, you will arrive at the taxable profit. You'll arrive at the taxable what? Profit. Now, how to deal with the taxable profit? It will depend on the nature of your operations. Are you a sole proprietorship? Are you a company? Are you a partnership? When you arrive at this figure, then that will kick in. If you're a sole proprietorship, you'll be treated just like an employee. An employee, we used to say less gross tax, 10%, 25%, 30%, then less personal relief. Same thing if this was a sole proprietorship, we'll compute tax on this amount following those rates. If it is a partnership, I think I'll teach that one next week. If it is a company, then this taxable profit will be taxed at 30%. Companies are taxed at 30%. All right. You have this illustration. You have this Alirine online shop, a small startup, that you are told they reported a loss of 289. Okay. Now these guys, and this is their sales, their cost of sales, their gross profit. And then the story continues to flow. They incur expenses, as you see down there, until they come to report a loss of 289. Let us see how this one is tackled. We have to go back to our expenses. Okay, starting with office rent. Here is your list of expenses. Let us identify the expenses that are allowable and the ones that are not allowable. From this list of expenses, let us identify the allowable and disallowable expenses. There you go. Tell me the expenses that are not allowable. Somewhere you have the answer. Identify quickly.
Legal
Depreciation?
expenses.
Depreciation.
The first one is depreciation. Hiyo tutakuwa tunajua. Next one.
Legal expenses,
Which one? There are two.
recovery.
Traffic offense.
Traffic offense.
Expense.
Traffic offense is not allowable, but the recovery of debts is very much allowable. Because
Yes.
if customers don't pay you, you sit back and allow them not to pay you. You should sue them to recover that amount, and that is encouraged. You'd be allowed on that. So we have identified depreciation, we have identified legal expenses, traffic expense. Next item, tuendelee, hatujamaliza.
House rent.
House rent. Reason?
It does not help the business in any way.
Because it is private. That is the explanation. Depreciation someone had given us. Depreciation someone had given us. Then this legal expense someone had given us. Can someone see another expense that is not allowable?
A loan repayment.
Loan repayment, there's interest of 12. The interest is allowable, but the loan, the other part of the loan is not allowable, which is how much? The other
Less
part,
to
yeah?
54.
Yeah?
Less in 1,000 from 54.
Which would be
42. 42.
42. And the other one that is not allowable is the salary to owner. When you own a business and you pay yourself a salary, it's not an operating expense. We don't take it as such. So we have identified.
If you're part of the company, even if you hold like a director position.
Now, for companies, we say something different. For directors of a company, it is allowable. But for sole proprietorships, it is not. And there's a reason to it. Now, see the expenses that we have said they are not allowable. We start with this loss. The reported loss, otherwise it would have been a profit. Reported loss, see the tax computation. See the tax computation. Reported loss. Okay. And then we add back these disallowable expenses. You had said house rent, salary to owner, depreciation, legal that is relates to traffic expense, and then loan repayment, the principal component of it. Now to 289, we add 582. And see the result. We now have a taxable profit of 293. We'll have a taxable profit. So these guys were reporting a loss of 289, but after scrutinizing the expenses they have, we found that they were deducting some expenses that were not allowable. We have added those expenses that are not allowable, and we arrive at their taxable profit. Now, you can read non-taxable incomes. You have like incomes exempted from tax. Windfall gains, those amounts that are not defined as taxable, like dowry collections. Should we say that because we have collected dowry, now bring it with tax, it has not been defined? Incomes that are subject to final withholding tax. And then finally, gain on disposal of assets. When you sell an asset and realize some gain on sale of that asset, then that gain is not taxable. We have second illustration, study it carefully. These guys are reporting a profit of 450,000. But after incurring these expenses, sundry expenses of 500,000, and then their income is made of this. They have this other income made of those amounts. Well, solution to this one is provided thereafter. You have it here, and you are going to study it after the class. The solution, that one you need just to study it. What we do right now is allow me to stop sharing the screen and share a different one so that we can solve an illustration before you leave. This question, you have it. I believe it has come on your screen. You have it on your virtual campus. I sent it before class, just a few minutes before class. You have this guy who runs hardware shop and has prepared this income statement, right? For the year ended 31st of December 2022. See that. He does sales from the hardware, which amounted to 3 million, and there's property development income, some other income of 760. And then he has expenses, so many expenses as you can see here. So can we run through the expenses up to the ones that you are seeing on your screen? Okay. You have the expenses. As usual, let me show you what the question is looking for. There's additional information, telephone, there's for the residence where it stays, and also for the office. Motor vehicle expenses, you are told 30% of them is private. Legal expenses, there's this one, debt collection and appeal, and then there's entertainment, part of which is for Christmas to staff, golfing expenses, for himself, it's important I give that clarity. And then his family outings of 56. He goes out and spends money. Books and journals, he has subscribed to property development books, the school books for his own children, and then annual subscription. What we need to see is that you are required to determine Mr. Musa Kari's taxable income for the year 2022. Now, carry in mind those additional items that are given. The expenses that I've highlighted, identify the ones that are allowable and the ones that are not allowable. Identify, take note of them. I'll pick another list. Now this one looks like a typical examination question. Now we are in our expenses. Salaries for office staff. Tell me, you think it's allowable? Yeah?
Allowable.
It's allowable.
allowable. Mhm.
It's allowable. What about salary to self?
Not allowable.
Not
No.
allowable. Mortgage repayment for his residence where he stays, do you think that is business?
No, not allowable.
Not allowable. That one is not allowable. Okay. Depreciation,
Not allowable.
not allowable, all that. Overtime pay to staff, do you have to do that in business?
Yes.
Yes. It's allowable. Subscription to Property Developers Association, When you subscribe, remember this guy is doing property development. When you subscribe to an association which is in line with your business, then that one is allowable. This one, Kitengela was their soccer club. When you make subscription for the benefit of your employees, we assume that that is a staff benefit is allowable. Rent of premises.
How would you be able to differentiate whether it's
Now we can only assume.
okay?
And in tax exams, you are told to write any assumption that you have made, because if
Okay.
it is for self, it becomes taxable. Rent of premises, where he's running his business from, he pays rent. Do you think that is allowable?
Not
Yes.
allowable.
Where you are
It's
running
allowable.
your
It's allowable.
It is allowed.
it is allowable. Interest on bank overdraft
Allowable.
is allowable. Telephone expenses,
Allowable.
Allowed.
ordinarily telephone expense would be allowable, but you are told that there is part of it that is for his residence. Now, that one that is for his residence will not be allowable. Do you see that?
Yes.
So we have highlighted that. Postage is allowable. Stationery, we are saying these expenses are allowable because they are business operating expenses. And then next is stationery is allowable. Professional indemnity cover is an insurance cover in case you fail in your profession, in your professional duty. Like if you're a doctor, you may treat a patient and he dies, and then they say you are the cause of that death, they sue you. You are advised to take a cover, this insurance cover that will compensate that patient. Or even an auditor can be sued, a lawyer can be sued, professionals get sued. As a lawyer, as an engineer, you can construct a building, it collapses, and you get sued. So you take some insurance cover, and that cover is to support your business, it is allowable. Motor vehicle running cost is allowable. Ordinarily, motor vehicle running expense is an allowable expense. However, we are told 30% are private. Let's not forget that there is 30% that is private. So we'll be calculating 30% of 60,000 is what? 30% of 60,000 is what? Have I lost you? You have to take a calculator. 3 times 6?
18,000.
Yeah. Parking meter fines. The moment we see the word fine, we know that that thing is not allowable. Repairs of equipment. What do you say? Repairs of equipment
Allowable.
is allowable.
Allowable.
Is allowable. What about purchase of equipment?
Not allowable.
Because
It's a capital expenditure or something.
it is capital expenditure. You are very right. VAT paid. Any tax that has been paid is not allowable. And I can tell you why. Like when you pay VAT, do you know it's not your expense? So you may charge customers wakakulipa your VAT. So how is it an expense? You cannot explain it as an expense. Books and journals, we come down here. Books and journals. And down here, you are told that there is property development books. You see, like if you're a doctor and you buy books that about medicine, you have to do so. It's an operating expense. If you are an architect, you buy books in line with that. It is an expense that is allowable. The subscription to a journal so that they can be sent new material is also allowable. What is not allowable is these school books for its own children. That one is not allowable. I'm showing you how you'll do the question in the exam. You'll have to identify like this. Legal and professional fees, once again, these are not. must take care of the notes. Legal, there is debt collection fee. In business, you have to collect debt. But when you have to appeal against a tax assessment, you are told to bear your own costs. That is not allowable. Then next is entertainment. Entertainment. See this one, entertainment. And these are not concerning entertainment. Entertainment, when you give your staff gift and when you give client, you are promoting business, it is allowable. But when you play golf for yourself and when you go outing with your family, we say those ones are not business operating expenses. Your family outing is not part of your business. It's not within the operation of the business. So those ones we disallow. Stationery, purchase of stationery, what do you say, people?
It's allowable.
It's allowable. What about purchase of household equipments?
Not allowable.
Because it's domestic. And also salaries to domestic servants, this one is not allowable. So we have done like 80% of the work. What's remaining is to present a solution, knowing the expenses that are not allowable. So we are going to take the net profit and add back the disallowable expenses. Once you have identified, hakuna kazi ingine, is take the net profit and add back the disallowable expenses. And that is majorly what we learn in this topic. So we come here and write Musa Karis. Income, sorry. Do as I'm doing quickly. Now, prepare a chart like that one, but you don't have to do the lines. You don't have to do these lines. You don't have to do the grid lines. See how my life is going to be simple. I'm going to say net income. I copy it over here. Net income. Then say add back is allowable expenses. Now, we are going to start picking the disallowable expenses and add them back. So the first one is salary to self. All these ones are disallowable. So I can pick them. It's very sweet working with a computer. Unaona hivyo? Add back disallowable expenses. Those ones we agree that they are disallowable. Go back and do the same now. Now you can do it. You have this. We have already added back those ones. Let us see the next disallowable expense. We have this motor vehicle cost. Don't forget motor vehicle cost. Let us not forget motor vehicle cost. So add back parking meter fines. Add back purchase of office equipment. Add back all these expenses that you have said they are disallowable. So add back salaries, add back depreciation, all these. We made arguments why they are not allowable. You'll have to take a lot of time in a tax exam thinking of what you are going to do. And when you are sure of what you want to do, then you need very little time to execute it. To make that argument, why should we allow this? Why is this not allowable? And that's what involves a lot of time. We are picking our disallowable expenses and adding them there. I pick these two. Can you see how life would be easy if you are allowed to do your exams using a computer? We also waste a lot of time writing. We pick this one. We said it's not allowable. I control C it. Come and do it there. Appeal against income tax. Control C it. Come and paste it over there. Next one. Golf. Golfing expenses. Pick it like this. See that? And then this. If you are using pen and paper, can you realize how you are taking a lot of time? There's this 30% of motor vehicle expenses. Let us not forget it. Private motor vehicle expenses. Now I can come and type it here. Private motor vehicle expenses. You told me they'll amount to 18,000. Any question up to there? Ukimaliza hapo,
You've made a,
yeah?
you've made a double entry of school books for own children.
Yeah?
Huko chini, you've made a
It's
double
not,
entry.
it's not a double entry, it's a repetition.
Okay.
Sorry. Thank you. And now what we need to do is obtain summation. Let me remove my coloring. No, it's not necessary. Let's obtain the total of these expenses. Let's obtain the total. Now, here is where we are disadvantaged, because if it was Excel, it would obtain the total for us. But sum it up. Let's get summation of these expenses. What is the sum of our expenses? We are finishing the next 2 minutes. What is the sum?
I'm getting 1,419,000.
That is the sum. And we can underline it. And then come and write here. Taxable profits. We add to the reported profits of 1173. You know what? They deducted all these amounts from 1173. That is what you need to understand. To arrive at this 1173, they deducted all these amounts. And we are telling them they should not have deducted. Therefore, had they not deducted the way they should not have deducted, then their result would be this value over here, which is, someone shout it.
25,92,000.
25,92,000. Now, if you are told to calculate the tax payable, this guy is a sole proprietor. I've not shown you how to treat partners. This guy is a sole proprietor. If you are told to compute the tax, you simply take 2592, tax the first 10%, the next 25%, and then the 30%, and then you less personal relief. You get the tax payable by this guy. So very good work. You can ask me a question. We have not tackled partnerships, and I really wish that we tackle partnerships. So we have not finished, and the semester is not over. So I'm not a slow lecturer. We are very much in time. Though there's a week we missed class, and last week our class aborted. That's why we have to push to next week. But next week we are still within the semester. So we'll meet next week to conclude on this. Now it's your turn to ask me a question.
I have a question.
Ask.
What is your plan for those who cannot access virtual campus for today's quiz?
Ni wangapi hazi access? Iko saa ngapi?
I know myself. I don't know if there is any other person.
Quiz iko saa ngapi?
Somewhere.
Yeah?
In the next
8 or 8.
Tuairishe.
Tuairishe ama to extend.
Naweza extend. Naweza tu extendia mpaka kesho.
Hapana, kama kesho
Not tomorrow.
Huh?
Maybe next week.
Hapana. Well, you'll talk to me those who have problems. What's your name?
Eunice.
Okay.
Even me, mwalimu, mine is not working. I'm Penina.
Okay. Go sort it out. Let those who are theirs working. Nitawapea quiz zingine.
Mwalimu, ile previous one nayo uliweka time kidogo sana.
You are meant to be fast. You are
Hey,
meant to be fast.
Unaona kama ya leo iko na adequate time. Ya leo iko na adequate time. But the previous one was
No, the previous one you had no calculation. Ni kuangalia value ukisema.
so you open basi kidogo basi.
Oh, but some of us will have to like do calculation, mwalimu.
Hapana.
It
Ya
is
leo niko na calculation kidogo.
Fungulie tena basi 1 hour.
Hapana. Kwanza wamemalizeni hizo and I give you some more. Hatujamalizana.
Na hiyo ingine umesema aje?
Hiyo ingine I need to see your performance. Haya. We can stop.
Sawa mwalimu.
Haya, tuonane wakati mwingine.
Okay.
Nitawatumia recording ya hii class.
Sawa, mimi nimemiss a lot by the way because I was in transit.
Today?
I've lost a lot.
I can leak your exam right now.
Please.
And tell you that there'll be a question on income, employment income, and there'll be another one on business income. The one that looks like this one that you have just done.
Ebu, oh yeah, that's good. In fact, I'm noting down.
There is no secret. Even if you decide to do a supplementary paper and is set by another lecturer, that is given.
At income tax?
Employment income and business income.
Na ni 15 marks, eh?
Hata moja inaweza kuwa 20. The first question is usually 20.
Hiyo employment.
Sure, lazima ikuwe employment, can also be this one.
Kuna kadhiori pia.
Theory itakuwa huko katikati, what is indirect tax, what is withholding tax. Theory itakuwa huko mingi pia.
Sawa, acha tafute 35, 20 na 15.
Asante sana mwalimu. Have a lovely evening.
You too.
Sawa sawa. Now kindly share the link, the recording.
I will.
Okay.